Hi, welcome to our YouTube channel, Rehan Talks. Today, we are bringing a very important topic for the investment community because a lot of buzz is going around. The new fund category, which is allowed by the SEBI under mutual funds regulations, is specialized investment funds, or in short called as SIFs. Many people are asking why I should choose this. What is different from the rest of the mutual funds? And why I should not actually go about picking up a PMS fund? Why I should use this one? So, this is an interesting topic on which we will be discussing today. And hope you will find this as very informative, and it will help you out in making a right decision whether the product is suitable for you or not. So, starting with our information on, so we will start basically on our disclaimer first. So, I am, my name is Vishal Trehan. I am a SEBI registered research analyst, and the information which is shared in this document is for information purpose only. No buy or sell recommendation is given. Then investment in securities market is subject to market risk. Please read all the related documents carefully before investing. For more details, you can visit our website www.vishaltrehan.in. So let's start. First of all, we will see what is the agenda. One by one, we will be covering all three products. First, we will understand the basics on the flexi caps. My understanding is most of you already know it, so we will cover it again for just a brief understanding and creating a background out of it. Then we will move on to the new category, which is a buzz around, which is SIF, Specialized Investment Funds. What are the categories? What are the features for those products? Then we will move on to the regulatory framework, because at the end of the day, we cannot risk our money, especially the large sums, when the products are not regulated. So, yes, regulatory aspect has to be covered, whether the SEBI governs it or the NP governs it, and how it evolves around this scenario. And at last, I will be giving you a pure comparison matrix where you will be able to understand what are the differences as one by one, side by side. That will be a comprehensive, so you get able to have an understanding to make a first hand decision on how you want to go about it, whether the product is suitable for you or not. So, first thing on the radar is flexi cap mutual funds. As the word suggests, even we have covered it in the mutual fund show. The flexi cap funds are basically the funds where the important thing is the flexibility, which is in the hands of the fund manager. Only requirement that is 65% of the corpus has to be invested in equity markets or shares. That is the only mandate which is as per the SEBI regulation in flexi cap funds. And rest, it is up to the fund manager to decide how much they want to allocate to a large caps or small caps or mid cap funds. So this is the whole reason that we can see this is called the most active management funds, and the fund managers actually make a difference when the flexi cap returns are to be considered. Then minimum investment, very good thing about is just like the other mutual funds which are already existing for decades, the flexi cap funds also has a ability to start an SIP. So you can start with as low as 100 rupees SIP or even a lump sum investment of 500 depending on the funds. Some funds might go for a larger number, and this makes it highly accessible for the retail investors. Regulation, these flexi cap funds are covered under the SEBI regulations. All mutual fund regulations are governed under the SEBI, and so the flexi cap funds are directly governed under that regulation. Then, fourth important pillar is the liquidity in the fund. Flexi cap funds, as like the other funds, are actually most highly liquid. Most of the mutual funds in India which are investing in equities are the highly liquid ones, because there are no lock-in periods involved most of the time, unless until you are investing for tax saving funds, which I guess now will be a bygone era, because the new investment regime or the new taxation regime, sorry, is actually not allowing those deductions. So tax saving funds will be a history. And most of the things we will see ELSS funds, direct investing, equity funds, and then flexi cap funds as emerging out. And out of that, we can see entry loads nil. For every fund, SEBI has mandated there will be no entry load. But exit load, yes, typically lies between 0 to 1% if redeemed in small period like 7 to 15 days. Most of the time, exit load will be nil if you are going to hold it for a period of time. Then this is the category where we are discussing about the SIFs, specialized investment funds. This is a new category launched under the mutual funds, launched recently in 2025, and handful of fund houses, like 9 to 10 fund houses, have already launched their SIFs, and we can see it over the next couple of episodes what they are. But right now we are trying to understand what this category is actually. So category, what makes it special? This category is actually designed for more sophisticated investors seeking alternative strategies, long short derivatives, concentrated portfolios, and thematic plays. In mutual funds, what happens is there is only long only. So a fund manager can only buy the stocks. Or if they think that in a flexi cap, even they have a adjustment capability, then they can go for liquid investments like cash or cash equivalents, because they think that market is overrated and they don't have the logical investment needs or the stocks which can be added in the portfolio. But on top of that, in SIFs, there is a strategy called long and short. So if a fund manager thinks that there are plenty of long opportunities, they can simply buy stocks and can hold it. But at the same time, if the fund managers see an opportunity that the market is in a bearish mode, or some of the stocks are in a bearish mode, and there is an opportunity to use derivative products to create an alpha for the investors, they will use it. That's why here it's not only long only, it is actually long short. Then derivatives exposures is allowed. Now that makes the product typically higher risk. And as higher risk is concerned, most of the time it will actually assume that sophisticated investors who can understand the risk. And that's why this product is more targeted to the higher middle class or HNI investors with minimum capital of 10 lakh. Yes, I'll repeat again. It requires a minimum capital of 10 lakhs and it is not withdrawable in the any fashion. There are I can give you an example, an analogy. Assume you want to open an account with ICICI Bank. Okay. So in the saving accounts which you are opening, it requires a minimum balance of 20,000 or 25,000 or depending on the city in which you are going to open it. Now, when you deposit the money, say you have deposited 1 lakh, but minimum requirement is 25,000. Now, what will happen is you cannot withdraw beyond 25,000 because that is the threshold which is required at the end. But in saving accounts, that is basically on a quarterly average balance. But if we compare it to the specialized investment funds, the minimum ticket size is 10 lakh. You can invest in 15 lakhs, 20 lakhs, 25 lakhs, depending upon the fund, how they are accepting it. But at the end of the day, if you have invested 15 lakhs, max you will be able to withdraw out of the fund is 5 lakhs. Minimum 10 lakh investment has to stay in the fund unless until you decide to close your investment and close that account with the SIF. Regulation. These are relaxed investment norms giving more flexibility than the traditional mutual funds, but they are still regulated under the SEBI mutual fund regulations only. As far as the flexibility of the fund managers, again, just like the flexi cap funds, here the fund managers will be having more freedom. Where on the flexi cap side, the fund managers were actually having a freedom on deciding on where to invest in caps of large cap, small cap, or mid cap, and then rotating the money in cash or cash equivalents and the shares. Even then, there is a cap that 65% of the investment has to be in the shares at any point of time. But in specialized care funds, the fund managers has the complete freedom. They can use leverages, they can use derivative products, they can use alternative strategies which are not actually prohibited regular mutual funds. So these are the things which makes the specialized investment funds little different. Now, when we talk about these things, then the investor's mind, the question comes up, then why not PMS? We already have a PMS product, then why to launch a special category of SIF? Now you will understand. In here, it's a personalized portfolio. Most of the in the PMS houses, they will create a separate demat account for you and they will hold the holdings which are specific to you. Most of the times, PMSs will be having a model portfolios and your portfolio will be designed around that model portfolio. But even then, customization is possible. Now, it's a very complete equity product depending upon the strategies the PMS chooses and the investor is agreeing upon. Minimum investment ticket size, that's why is higher. It requires 50 lakh plus. Yes, you heard it right. Minimum investment in a PMS requirement is 50 lakh plus for an individual. So this actually is actually suitable for only on high net worth individuals. Regulation says registered as portfolio managers. So it is not regulated under the mutual fund regulations. It is a separate regulation where portfolio managers are registered and the funds are registered. Client assets are held in the separate demat accounts. So you could see what are the stock holdings which are specific where your money is invested. Complete transparency is available. Now, first angle is the cost comparison between all this. Entry load, as the SEBI has banned any entry loads, so we can see entry loads in all the investment schemes is nil. Next is the exit load. Still some exit loads exist. Flexi cap, it is between 0 to 1%. Again, only issue is if you are withdrawing it too early within a 7 to 15 days period and something like that. And it also varies based on the fund house. SIFs, if you are going to withdraw within a 1 year, then you will be paying an exit load of 1 to 2%. Because understand that these products are not for short term in nature. SIF product is basically meant for the investors where investing horizon is more than 3 years. Because strategies will be designed or the fund managers will be taking the very active calls and short periods like 4 to 6 months or even year is not suffice to judge whether the fund is able to create returns for the investors or not. That's why they will be keeping an exit loads if redeemed within a 1 or 1.25 1 to 2% within a 1 year. PMS, again, they has cap 3% in the first year, 2% if we go to second year, and 1% in the 3 year. And thereafter, most of the PMS don't charge any exit load after that. Management fees. Flexi cap has a management fees which is lowest as the fund cap management fees is capped by the SEBI in mutual funds at 2.5% per annum. But most of the mutual funds are actually dealing between 0.5 to 1.5% and we normally call as expenses. But in SIFs, we will be seeing that expected range will be between 1.5 to 3% per annum. In PMS, it is completely different scenario. The PMS, every PMS has its own structure. They can go for anything ranging from 2 to 3% as a management fees. There is no cap. In addition to the management fees, PMS funds are also charging performance fees. There is something called hurdle rate, which is the minimum benchmark ROI or IRR which a fund will generate. If above that, then they will start charging the performance fees as well. Then rest of the other costs in flexi cap mutual funds, lowest, SIF will be in between and PMS will be highest. So out of this comparison, we can understand that SIFs will actually lie between your flexi cap and the PMS schemes, where in SIFs you will be able to enjoy the benefits which are coming with the active fund management by the fund manager, which will try to generate an alpha, whereas we will not be paying the same cost which is paid by the PMS users. Now, after understanding the cost structure, we need to understand whether it actually suits your profile or not. If we typically profile somebody, an investor in FlexiCap, we can easily say that a first-time investor, you don't know how to select the funds based on large cap, mid cap, or small cap. It's better to go for a FlexiCap funds because you will get the exposure and fund managers' professional expertise, which will decide where to invest. So it is suitable for small to medium investors as SIPs ranging from 100 to 500 are available. So small SIPs can be done. Flexi caps are very simple products, long only funds. There is no extraordinary alternative strategy. Regular income earners, easy SIP, you can start on a monthly basis and it can continue for years. Gold based investing, you can actually make it a gold based investing. Say, after 5 years down the line, you want a money to pay for your housing, house purchase, down payment, or you can say you are going for an 18 years, which is the fund you need for your child's higher education. You can go for 20 to 25 years for your retirement funds. So gold based investing is completely possible and is aligned for flexi-cap funds. SIF, as it's a sweet spot between the flexi-cap and the PMS, but it is for experienced investors because derivative exposure will be there. So the investor should be experienced enough to understand what risk he is taking. That's why the HNIs are asked for with a cap of 10 plus. Alpha generation, most fund managers will try to beat flexi cap returns in this case because they will be having a shorting scenario possibility if the market goes down or the stock is showing a weakness. Alternative strategies, you will be able to enjoy more in ISF, obviously, and higher risk appetite will come into this. If as an investor you don't have a higher risk appetite, you will not be able to choose. PMS, as far as ultra HNIs are concerned, 50 lakh plus ticket size. Customization, you want the portfolios as per your requirement, you will go for PMS. Direct ownership on stocks, you don't want the units, you want to own the stocks. For most sophisticated investors who understand how the financial market works and how they want to hold their stocks and the portfolios. Tax planning needs will be surely required for the higher generating, income generating ultra HNIs. Now, let's make a risk and return expectation how this is going to pan out. So, this is just a indicative. Please don't judge it as a real risk. So, we are just assigning some numbers and so that we can compare where it lies. If we are going to assign a flexi cap mutual fund a risk level of 65 out of 100, then SIF is little higher, 80, and PMS is even higher at 85 because there is a direct investing in stocks and you will be watching your portfolio going up and down based on the strategies which the PMS has chosen for you and you have agreed upon. Now, returns perspective, what is happening? Over the last 4-5 years, we have seen that flexi cap portfolios or the mutual funds can generate anything between 15 to 17%. Some years they have been better returns, but some has been lower. So I am taking an average out 15 to 17% flexi cap funds has been generating. But expectation out of SIF will be like they will be beating these returns because of the alternative strategies which are available at the disposal of the fund managers. So I am expecting the SIF, they should be able to create more than 20% return for the long short categories. Now, PMS, it's a varied whole. We have a history where the PMS houses are generating even 8% or 10% return. And we also have the PMS houses in the country where are generating more than 40% CAGR. So this is a varied altogether depending on the risk or the potential, which is varied depending on the fund houses where you are invested. I hope this makes a real picture. It is actually an indicative picture so that you can understand if you are taking a higher risk, there is a chance of higher return. So for otherwise, for a higher returns, you need to take a higher risk. Now, after analyzing and getting a one-to-one comparison of the things, I hope you understand that why SIF are most probably called out as in the sweet spot. They are better than flexi cap because of alternative strategies which will be allowed. They can use the derivatives, concentrated bets always allowed, and long plus short strategies will help them out. Accessibility is more than the PMS holders because in PMS 50 lakh minimum ticket size, here even a high net worth individual with 10 lakh plus ticket size can invest. Fees will be lower. There is no performance fees in this case. SEBI regulated will be there and easier to start as you can go for a simple mutual fund advisor where you was already investing with your flexi cap funds. Professional management, All funds are actually coming under this category because fund managers are professional in nature. It is their day-to-day job. So we will be getting this information. They will be research-backed decisions. Diversification benefits are available. Risk management will be taken care by the fund managers. Timing, it's a new category, I would say. So we cannot say how to rightly time it. But yes, being starting at an inflection point, it is expecting that if the market moves in the right direction, then SIF will be a good category to investor. Early mover advantages, and it's a growing market segment and surely have a good future potential. Now, before we close this presentation, let's have a quick overview again. Once again, comparison metrics we have side by side. Flexi cap, you can go for minimum ticket size 500 to 500, anything. SIFs have 10 lakh. PMS, minimum ticket size 50 lakh. Regulations says mutual funds. Flexi cap are regulated under mutual funds. Similar is the SIF, but little lower regulation because they are giving more flexibility. But again, everything is under the SEBI. But Flexi cap and SIF under the mutual fund regulations, whereas PMS is having both separate portfolio managers regulation. Liquidity, flexi caps will give you highest liquidity because funds will be in your bank account within 1 to 3 days after your redemption. In SIF, as I told you, there is a minimum requirement to be invested at any point of time. That is the 10 lakh ticket size. Over and above that, you can withdraw. PMS, again, depending upon the PMS houses, the liquidity will vary. Customization, flexi cap, there is no customization because you will be seeing whatever is invested, it is as per the norm and it is going into securities market. SIF, little customization will be there because of the derivative exposure. They can go for a lower risk on the equity side as well. Concentrated bets are allowed. PMS, it's a full customization. You can even choose that you want to hold a specific stock or not. Strategies, flexi cap can only vary between what is to be invested in large cap, small cap, or others. They have a 65% cap which needs to be going to equities. The rest they can arrange. SIF, there is an added advantage of derivatives which will come into the picture. And for PMS, it is unlimited. They can do anything what they want. It is all about the mandate which the investor has signed and the PMS has agreed upon. Transparency, you will see monthly reports or fact sheets will be generated for the flexi cap and SIFs, just like other mutual funds which we are generating. PMS, it is a real time, so you can see what is happening in your demat account, what stocks you are holding and how they are performing. Ownership, flexi cap and SIF, you will be getting the units because NAVs will be declared. In terms of PMS, it is a direct stock investing, so it's your equity value. Tax treatment, all are treated as long-term capital gain and short-term capital gain depending on the period on which you will be holding the stocks or the units. Flexi caps are the best suited for best beginners who don't know anything. They can start with this. SIF is a product which is made for little experienced HNIs and PMS is ultra HNIs. So to ease out their decision framework, simple as that. If you want to invest less than 10 lakh, your better option is flexi cap. You can go for your wealth building generation journey starting with this with an SIP. Systematic specialized investment funds, if your ticket size is 10 to 15 lakh. Here also SIPs are allowed, but it will not be in the terms of 500. It will be in a higher range of 10,000 to 15,000 per month. But even that will be allowed after you give 10 lakhs as an initial investment to be in the fund. PMS 50 lakh plus, there are no SIPs. Once your money has to be given in lump sum and your portfolio will be created and customized according to the fund managers. I hope this presentation would have been helpful to you and you will be able to explore more of the SIFs. Even you can reach out to us. You can mention in the comments if you have any queries and we can resolve it. I hope this starter give you enough information that you can start your SFA journey today. If you have liked this presentation, I would request you to please subscribe to our channel and switch on the bell notification so that whenever an informative video is put up on the channel, you get an information and you can check it. I hope you will be able to share it with your friends and family so that they can also benefit from this. Thank you for listening. I hope we will meet you in next video with more information and more informative content as usual. Thank you.